Hey everyone, and welcome back. Today we're going to be talking about options, and in particular, one of the most popular options strategies. I'm referring to the Iron Condor. So if you are interested in this type of strategy, stay tuned. But before we start, as always, I'd like to remind you to please go and subscribe to our channel. Please go and click on the notification bell, and also leave us a like to this video. We thank you so much. All right, so why are we talking about Iron Condor? Well, as I mentioned, it's one of the most popular strategies, so I'm sure it does interest many of you. And then it's presented on the internet, in various books, courses, as kind of panacea for all ills. And instead, we'll see altogether that, like the strategies, it has its pros and its cons. Moreover, it seems to me that it's also presented in a way that isn't entirely accurate. What I mean is that I think that this strategy fails to perform at its best with the typical setup that it's usually presented with. But let's go in order. First, what is Iron Condor? It is an options strategy consisting of 4 legs, that is, 4 options, as we see in this chain. It consists of 2 call options and 2 put options. So we have a call credit spread and a put credit spread. So let's build it together. So let's create a new strategy. Here it is. Let's sell a call. And at, let's say, 100 points, for example, let's buy a call, okay? And then we'll limit the risk in case it does go up. Now, notice that I used options from delta 10 to about delta 5 in this credit spread, okay? And it's a spread of about 100 points. Now, the first option sold is at delta 10. And then let's do the same for the put side. So minus 1, 100 points plus 1. Right, here is our Iron Condor in the typical form in which it's presented. Note also the deadline, 30 days. And this is the standard setup that you can find in several books and online presentations related to this strategy. Now, in this video, we'll use options on the SPX index, which we know is one of the most liquid indexes in the world. But what is the purpose of this strategy? Well, it's to profit from the passage of time or a decline in volatility. The condition is, of course, that the underlying asset remains within this range. So let's go and try to simulate the passage of time. So we have our green line, which corresponds to the profit and loss of the strategy until today. And if we continue for 10 days or so, our profit will increase if the underlying asset stays within this range, so within this area. And if we go even further, we'll see that our profit area gets bigger and bigger, and then takes on this form at maturity. The same thing happens when volatility goes down. So typically, opening an Iron Condor is usually more profitable when it happens at times of high volatility, provided that the underlying asset doesn't have strong movements at those times that would take it out of our profit zone. So we understand that over time, Iron Condor benefits from a decline in volatility, but loses when there are abrupt movements in the underlying or an increase in volatility. Okay, so what are the benefits of Iron Condor? Well, aside from the aspects that characterize it, it certainly has limited risk. So in case of movements of the underlying asset, our loss in this case has a cap limited to about $8,800. So compared to for example, selling naked options, we can say that this is a more conservative strategy, in a sense that the worst case scenario is already predicted within the strategy. Now let's come to what I consider to be the most negative aspects of the strategy, as it's usually presented. It is pretty evident from the structure that the profit is quite disproportionate when compared to the maximum loss that one could have. So the maximum gain is about $1,200, and the maximum loss is $8,700. That's definitely an extremely negative aspect. Now, when it comes to options, those who propose strategies often focus only on the high probability of success. And it's clear that such a strategy has a high success rate. But the problem is that a single loss is enough to wipe out perhaps months and months of gains. So that's the first aspect that I don't like about this kind of setup. So what is the problem with this strategy? Well, the problem is that we sold options extremely far from the price of the underlying asset at delta 10. And that gives us a high success rate, but also an extremely unfavorable risk-return ratio. So, personally, I prefer staying closer to the underlying asset and having a more balanced risk-return ratio. Another aspect I don't like in this kind of setup is selling credit spreads at a constant distance. In other words, 100 points for calls and 100 points for puts. But why don't I like this? Well, because volatility is very different for options. We know that not all options have the same volatility. In fact, puts typically have higher volatility, and this creates a distortion. So the delta of our strategy is negative. But what does this mean? Well, it means that we start with a strategy that has a bearish base, even though we know very well that the markets, the stock indexes, tend to go up in the long run. So that is something to keep in mind. With this iron condor setup, you often lose on the bullish side. Why? Well, because as I mentioned before, we start at the beginning with a structure that is itself bearish. And this aspect becomes even more apparent when we move the deltas closer to the price of the underlying asset. So this is the first aspect that I don't like. And I have no doubt that you're assuming how you can have a structure that is genuinely delta neutral. That is a structure that has no bias, that is actually market neutral. Well, you have to sell the put options at a greater distance than the distance between the call options. So that's called unbalanced iron condor. And we see that we are now approaching the zero delta. We're still not very accurate, so let's try to fix it again. 0.90, 0.36 here. This is a structure that is balanced in itself. So if we wanted to open an effectively market-neutral iron condor, we would have to do that. In other words, we'd have to sell put credit spreads farther than call credit spreads. Another aspect I don't like about this setup is the 30-day maturity. It's often explained that a 1-month maturity is used because options tend to expire more in the last month of their term. And well, you see, that's not always true. Actually, it applies only to a particular type of options, which are ATM options. And we can see it best in this graph. ATM options, namely those on the gray line, tend to decay more in the last month. However, this isn't true for the in-the-money options and the out-of-the-money options. Indeed, out-of-the-money options do precisely the opposite. They have a higher decay before 30 days, and from 30 days on, that decay slows down. So you understand that when we sell Delta 10s with a 1-month maturity, we do precisely the opposite of what should be done. And not only that, another aspect that makes me want to work with longer maturities, for example, is related to gamma. Now, gamma is a second-degree Greek value of options, which is, to simplify it, the curvature of the at-now curve. So the greater gamma is, the greater the curvature of our current payoff, and the more unstable the strategy is. Now, it just doesn't take too much movement in the underlying asset to go into loss. And when we work on short expirations, we'll always have a high gamma, which means that our strategies will be much more unstable than other strategies with long maturities. And that makes us monitor the strategies and intervene more often. And that's something that I honestly don't like very much. But I don't know, maybe that's just a little bit more of a personal aspect. At this point, I want to show you a little backtest that was done using an automated options backtest platform called Get Volatility. In the test, we're selling an iron condor at Delta 10 versus Delta 5, duration 30 days, held for 15 days, and closed with a 75% profit. As you can see, the strategy is profitable, but from 2018 to date, it made a very small profit. And not only that, it's visible during the COVID period how the strategy has thrown away months of profit, although not particularly important, in a very short time. Then it was able to recover just because we were in a period of high volatility. So Iron Condor certainly benefited from being open during periods of high volatility. And it took us 4 years, or almost 5 years, to be back in profit compared to the initial value. So over the long term, the strategy isn't particularly successful, at least not with these rules. Now, that said, I will leave you with a suggestion. If you're truly interested in Iron Condor, I'd advise you to work, if you're working at 30 days, with options closer to out of the money. I'd even advise you to extend the expiration. So work with longer expiration dates precisely because that gives you more time to intervene. And that way you aren't forced to sit in front of the monitor all the time to manage its strategy. And not only that, always remember that our Iron Condor structure would be inherently unbalanced if we opened it with strikes, with credit spreads with the same distance between them, between call and put. So the ideal is to open an unbalanced Iron Condor to have a strategy that is market neutral. And last but not least, the most important piece of advice perhaps is always test before you go live with a strategy. It's imperative to test what would have happened in the past if you had applied specific trading rules. And that's exactly what we do here at Unger Academy. The systematic approach to markets is essential, whether automated or not. See, we need to have rules, and we need to know how our strategies have performed in the past. So if you are interested in learning more about systematic trading, we're going to leave a link in the description of this video. There is a free presentation by Andrea Unger through that link, where he introduces you to his trading method, the Unger method, which he used to win the World Cup Trading Championships 4 times. You can also go and get the bestseller, the Unger method, covering only the shipping costs. And also through that link, you can book a free strategy consultation with a member of our team. And that is all for today, guys. Thank you so much for watching. Please leave a like if you enjoyed the video, and also subscribe to our channel too. And with that, we'll see you soon in our next video. Until then, bye-bye.